when we talk about performance evaluation, it is just the other word for variance computation, because it is an exercise where we compare the expected value and the actual value. Now, something is called expected if it is determined in advance. And therefore, this expected is the other word for standard. Now, the variance is the difference between the expected and the actual. And as we know, what we came across in variances, we said it can either be adverse or favorable. Adverse means it is bad, favorable means it is good. Now, if you report a good variance, you are rewarded. If you report a bad variance, you are punished. Now, in doing this performance measurement, a business must be broken down into what we call responsibility centers. And any good responsibility center should have three characters. One, I'm reading page 12 for a handout. It should be clearly defined in terms of boundaries. There should be a direct link with the manager. That is what we call appropriate span of control. There should be clearly defined categories of costs. And we have 4 types of responsibility centers. The first one is called cost center. That's where we look at the costs. The second one is called revenue center. There we look at the revenues and the measures of performance. Then we have the profit center, where we look at the profits. And number 4, we have an investment center. Now we have 3 main measures of performance. We have what we call return on investment. We have what we call residual income, and we have economic value added. Now, when it comes to financial, or when it comes to performance measurement, you can either use financials or non-financials. I think I will discuss the non-financials later on, because we have a subtopic to discuss that. Then, when you are measuring performance, you must also recognize the concept of control. That is, a person should only be judged on the basis of what is within their control. And in compliance with that, our income statement is prepared, as you can see there. There is the income statement that is provided there, and we shall be discussing it as we have questions. Then there is the return on investment and residual income, as I have mentioned. And I think whatever is there in the notes, it is better explained as we have no questions. So having said that, let's go to our past papers. Let's go to our past papers. And in our past papers, I want us to handle this question of July 2000. July 2000. Which is question 3A. July 2000, question 3A is on page 180 or thereabout. July 2000. The question says that the Z division of XYZ Limited produces a component which it sells externally. And it can also be transferred to other divisions within the organization. The division has set a performance target for the coming financial year of residual income of 5 million. The following budgeted information relating to Z division has been prepared for the coming financial year. We have the maximum production stroke sales capacity to 800,000 units, sales to external customers, variable cost per component, fixed costs directly attributable to that division, capital employed with that, and then view the XYZ has asked Z division to put a transfer price for units of the component. So you are told now to calculate the transfer price per component, which Z division should quote to X division so that its residual income target is achieved. Now, in answering that question, you will begin like this. You will say that residual income is equal to divisional income or divisional contribution or divisional income, you minus the cost of capital. Now that formula is in our handout on page 12. That formula, that's where it is. And then we are going to use the statement, the divisional income statement that I have just mentioned on page 13. You can have a look at it because that is the one that we are going to use, the divisional income statement on page 13. Now, this one, it requires that we get a receipt. So we will start by saying, let P to be the transfer price. Let P to be the transfer price. Then, if you rate it that way, then the residual income is 5 million here, should be equal to divisional income. Now, divisional income, you need to get the sales, the external sales, which are 500,000 units at 37. You add the internal sales. The internal sales are 300,000 at the price code P. Then you minus the variable cost, which is 800,000 at 25. I hope you are still following the statement. You raise the variable cost. Then we raise the fixed cost, which are directly attributable to that, which is 1.4 million. Then we raise the cost of capital. And the cost of capital, we are told, is 13%. 13% of the capital employed. I can see the capital employed is 20 million. The capital employed is 20 million. So solve that and tell me what is the value of P from there. Solve that and tell me the value of P.
Mko sawa? Niko si. I hope mko sawa. I hope mko sawa basi, yani mnapiga hesabu yenu mdogo mdogo. Haya, pigeni pole pole na sheets. Na mkienda kesho mnunue ya mtumba hapo Kanamu. What do you say? Mkinunua ya mtumba Kanamu ama lazima mnunue hiyo mpya? Mimi nauliza, hebu mdiscuss hapo mkubaliane alafu mtaniambia baadaye. Kaeni tu pole pole. Niko hapa kwa city lakini sasa mtatoto So kila mtu mbili mbili. Oh, sawa sawa. Haya. Pigeni hesabu sawa.
So what have you gotten as the answer? P is equals to 35. Good. P is 35.
No.
So that is how you get it. P is 35.
Okay.
Then part 2, the question is asking, explain why the transfer price calculated in one above may read suboptimal decision.
You have to log out, then log in.
Point of view of XYZ Limited taken as a whole. So you write this. Suboptimal decision making. Suboptimal decision making is a situation whereby someone makes a decision for their own good, at the expense of the others. At the expense of the others. At the expense of the others. Okay. This price of that 5, reduces the profit per unit by 2 shillings. Reduces the profit per unit by 2 shillings. And therefore, it will make the division manager to make decisions for his own good. To make decisions for his own good at the expense of the company. At the expense of the company. As he tries to maintain his profits. As he tries to maintain his profits. As he tries to maintain his profits. Okay, so I think that is good enough. The next question at hand is May 2002, question 5. May 2002, question 5. May 2002, question number 5. I want you to read that question as I design how we shall work it out. Design how it will look like. Just read through so that when we start solving, you will not be lost. So I've said the question is May 2002, question 5. The question of May 2002. Question 5. So in this question, I have details. And in the details, I have income when divided by revenue is called margin. Called margin. Then I have revenue when divided by assets. When divided by assets is called capital turnover. It's called capital turnover.
Hello. Hai. Sasa tuliongea jana nini Kang'olo huyo sub county tukakubaliana 150, lakini akaniambia niende nisikuje huko, yeye atanipigia.
Samal, make sure you mute yourself. Let me mute. Okay, sorry for that disruption. The next one is if you take margin multiplied by capital, let me write the full name so that I don't take a lot of space. Return on investment. Return on investment is given as margin times capital turnover times 100. That's what we call return on investment. Is equal to the next one. The next one is residual income. Residual income equals income minus cost of capital minus cost of capital so we design a table like this. Then so the first department is called newspapers. Newspapers. The second department is called television. Television. And the next one is called film studios. Film studios. Film studios. So you are through at that point. So if you are through, what we shall do is very simple. We are using the values for, so maybe this one we could say performance measurement. Performance measurement for 2001. For 2001. Performance measurement for 2001. And we just take the values of 2001 for the income. I have 1100 here. Television iko na 160. Na huyu ako na 200. Then you take revenue. Revenue is 4600. Hii ingine ni 6400. Hii ingine ni 1650. Then hapa ni 4600, 6400, 1650. You take the assets. The assets are 4900, 3000, and 2600. I want you to work with two decimals. Work with two decimals. Work with two decimals. So, nisome what you have here, 0.24 here, 0.94. Okay, then sasa ukikuja hapa utasema ni 0.24 times 0.94 times 100. Give me that 22.56%. Now, in getting the income, the residual income, utasema ni 1100 minus 12% times the assets. The assets are 4900. The assets are 4900. You have 512. You can be able to do the same for the others. Okay, finish that table. Okay, so Yusuf, I believe you are through with the prayers during that break. Is that so? Good. So the next thing that we need to do below that is new project. For the new project, return on investment. There is a new project they have proposed there. There's a new project they have proposed there. And that project is going to have a return of what? Is it that? A profit of that. And it is going to cost us what? 200. That is 15%. Now, what we are computing here are measures of performance. And it is what earlier on I referred to as financials. You can see these are quantitatives. So you can either use margin, you can use capital turnover, or you can use return on investment, or you can use residual income. Now, margin, we know it is the profit expressed in terms of revenue. The meaning of this is for every 1 shilling of revenue, you have a profit of 0.24. For every 1 shilling of revenue, you are making a profit of 0.24. This one, it means for every 1 shilling of assets, you are able to generate 0.94 of revenue. And then this one means for every 100 shillings you have invested, you are making a return of 22.56. And this one means from all your investment, after umetoa cost of capital, this is what remains for you. So that is how they are interpreted. Obviously, the higher, the better. The higher the value, the better. Now, we have computed this one because these methods are also used for appraisal purposes. These methods are also used for appraisal purposes. So the question is, should we accept the new project or we should reject the new project? So this is what I want you to write below there. If return on investment method is used, if return on investment method is used, the new project will be rejected. The new project will be rejected since it has a lower return. Of 15% than the divisional return of 22.56%. The second point is, if residual income method is used, the project will be accepted. Since it has a higher return. of 15% than the minimum required rate of return, of 12%. Yeah. So that is how you appraise, and all that, or what we have used in making those statements, you will get those points in your notes on page what? On page 13 and page 14. Page 13 and page 14, that's why you should get them. Haya. Si hapo tuko sawa? Okay. The next question that I want us to solve is yes, this one of is a December 2013. December 2013, question 5B. December 2013, question 5B. December 2013. Read through. December 2013, question 5B. So we have details here. Now this is called performance measurement fitment. Performance measurement fitment. In this one, what you do, we have the year 2014, 2015, 2016, 2017. And the projects are project 1, 2, 1, 2, 1, 2, 1, 2. Sign that way. So once we have done that, the first thing to bring here is called opening value. Opening value. You can call it A. Opening value, you can call it A. Opening value, you can call it A. For the first project, you can see it is 10 to 40. 10 to 40. And the second project is 8320. 8320. The second item to bring is called depreciation. Depreciation, call it B. Depreciation, you call it B. So what you will do, these projects are being depreciated for 4 years. So divide this by 4. These 10 to 40 divided by 4. 2560. So your 2560 weka kwa every project, kwa every year of project 1. 2560 for the 4 years of project 1. Now divide this 8320 by 4. 2080. That is the depreciation for the second project. 2080. 2080. Then we get another value called closing value. Now this closing value will be given as A minus B. Closing value will be A minus B. So let us start with the first project. With the first project, 10 to 40 minus 2560 is what? 76. Now that 7680 becomes the opening for that project second year, 7680. So subtract 2560 again, 5120. That becomes opening that year of that project. Subtract 2560. 2560, that becomes opening the second year, so that you close with what? 0. Let's do the same for the second project. 8320 minus 2080. 6240. Now 6240 opens. So you less 2080, you get 4160. So 4160 you less, you get 2080. So this 2080 you less, you get what? 0. Get 0. Something else that you require to get is called cost of capital. Cost of capital. Now, cost of capital is obtained as, according to information 3, you can see a 16%. So it will be 0.16 of A, and we call it C. We call it C. We call it C. So once the upper 16% of 10 to 40. $16.90, $16.38.4. Give me now 16% of 8320. 1331.2. Aya, tuende kwa the next. $428.8. 28.8. The next. 908.4. $819.2. 665.6. Just take this one. 409.6. 48 for 2.8. 332. 332.8. Good. From there now, you bring someone called cash flow. Cash flow, we call it B. Cash flow, we are going to call it B. And this one is as given in the question. As given in the question. So the question as given as 3840, 4160, 3840, 3520, 3840, 2400, 3840, 1600. The next item we need to compute is called income. And income will be given as cash flow D, U minus depreciation B, and this one we call it E. Call it E. So tuanze ya kwanza 3840 minus 2560. 1280. Actually, this remains the same for that project. Ile itakuwa inabadilika ni the second project. Haya, sasa niambie the second project. 2080. $1440. 320. Negative 480. Negative 480. The next one is called residual income. Residual income. Now residual income, we shall get it as E minus the cost of capital. E, you minus the cost of capital. Haya, so tuanze. 1280 minus 1638.4 is negative 358.4. Seven, 4,8.8. 51.2. 4.6. 460.8. 6. 8. 8. Okay. Return on investment. Return on investment. Now, this return on investment will be given as E. You divide by A. Then you multiply by 100. E, you divide by A, you multiply by 100. We can use two decimals wherever there are decimals. Tunasema 2.5, 12.5, 12.5%, 25%, 7%. Three 3.6%. 7.7. $50. Clear? Negative 23.1. Any figure disputed? This one. It's 23 points. So 23.1. Okay. 3.1%. Now below that, I want us to do the summary. The summary or the averages. So we have the project here. Project 1, project 2. So the summary is also the averages. So I think a summary stroke averages. Summary stroke averages. And we start with the residual income. Residual income. For the residual incomes, I have minus 358.4. This is 748.8. So plus 51.2 plus 441.6 plus 460.8 plus minus 345.6 plus 870.4 plus minus 812.8 equals, you divide this by 4, you divide by 4. You divide by 4. So we are going to do the same. We're going to do the same for return on investment. Return on investment. Return on investment. So when it comes to return on investment, I have 12.5 followed by 25 here. So plus plus 16.7, 23.1 plus 25 followed by 7.7 plus 50 followed by minus 23.1. You divide by 4 years. Divide by 4 years. You get the averages. Get the averages. What have you got in here? 256. Then here 8 here. 0.05. 8 points. Yeah, so that is how you compute those kind of values. And I think that is very, very clear. So maybe for your assignments, you can attempt the following questions. December 2014, question 3. December 2014, question 3. May 2016, question 5B. May 2016, question 5B. November 2017, question 4B. November 2017, question 4B. May 2018, question 5A. May 2018, question 5A. And September 2021. September 2021, question 1. Actually, you can answer the whole of it. September 2021, question 1. Those questions are very similar to each other. Make sure you attend. Now, the next thing that we are supposed to discuss, going back to the handout now, is called dysfunctional consequences of using short-term financial measures. When we talk of dysfunctionality, we are talking of something fulfilling a different purpose from what it was originally intended. Like if I came to this class and started teaching music, I would be regarded as dysfunctional because I was not initially sent to teach music. I was sent to teach EMA. Now, these are called financial measures. If you look at the questions we have solved so far, they are coming from financial statements, the profit, the depreciation, the cost, and so on. And you can also see they are yearly. So because of being yearly, that's why we are calling them short term. Now, this performance measurement, as I had begun saying when we began the topic, is that they're supposed to measure performance. And the general objective is that when you know your performance is being checked, you will give the best, because none of us would want to be found in the wrong. But as you can see, there are instances where these dysfunctional consequences comes about. And one of them, or a good case, is where we are given those situations where they arise. If you look at the handout, it is where you reject a project that has short-term outflows but long-run inflows, to accept a project that has short-term inflows but long-run outflows. Now look at what is happening here. If you look at project 1 in the first year, it is reporting a negative year, while project 2 is reporting a positive year. So if you are also to look at the rate of return, you can see project 1 is having 12%, while project 2 is taking 25%. So on the face value, if you are the manager and you know your performance itapimwa based on this, then utaendea hii project 1, because you can see project 1 has a higher return, it has a positive cash flow. You utaendea project 2, so you reject project 1, which has a negative flow here and a smaller percentage. But if you look at how things are turning as we go by and by, they turn such that by the time we are in the 4th year, the project that appeared not doing so well now has a whole 870, while the one who appeared better is now having negatives, minus 812. The one who appeared with a smaller percent is now ending with what? 50, while the other one is ending with what? Minus. And if you are to look at it as a single figure for the average for the whole period, then you see the same picture. That project 1, which did not appear promising here, which has a whole 256, while the one who appeared good is ending with paltry what? 8. The one who did not appear good is ending, or average, is having 26. Well, this guy has what? 8. Now, this is where you hear that it is important to make loss in the short run as you strategically position yourself for the future. A good case is what you people are doing. Coming back to school, you are here. Kwa negative. Your school fees unalipa, it is a negative to your finances. And you are not making a lot of money because hii wengine wakiwa huko kwa biashara wewe uko kwa class. When the others are doing what they are doing, wewe uko hapa. So you are making a small return. But after you qualify, things will turn very fast. They will turn. I don't know whether you have seen these kind of fellows who have spent a lot of money or a lot of time sharpening themselves. When they come to the market, they shoot very fast. And they leave the others who have been there for many years. Yeah. Simply because these guys took time, they invested in themselves, and now when it is time to work, they move very fast. So this is a very serious concept, very, very important concept, even in general life, especially when someone is young. It is very, very important you position yourself making losses. You invest even heavily. Don't be the kind of fellow who wants very nice life. I have no problem with nice life when someone is young. It is good to enjoy life. They tell us you live once. But as you live once, remember you may live a little bit what? Longer. You know, there are those fellows who tell us, what if I die today? But you also need to ask, what if you don't die? You need to ask those questions. So that as you squander all your salary, because you can die today and utaki kuachia mtu, you also need to ask, what if you don't die? Na ushakula hiyo mshahara yote. You see, that's also a genuine question. Yeah. So it is better you invest. Hapa ndio unasikianga mtu amenunua kaplot ka 100, to plot to 200. Somewhere in the bush, hata mahali hakuna barabara, but a few years down the line, unapata hizo plots sasa ndio wanauza millions. Si ndio? Yes. But kama yako tu ni kukula mandazi hapa na pale, kununua pizza, sijui kuenda carnival, sijui kuenda wapi, siku yako hiyo miaka ikifika utakuwa huko kwa negatives. When your colleagues now, when you are invest, so you need to be smart. You need to be smart. Afadhali ukae mjinga for a while, but in the long run ukae mwerevu. Kuliko ujifanye mwerevu for a while, then later on ukae mjinga. You know some of these things, ndio unaulizana kwa later on, ama hata wewe mwenyewe unajiuliza. Ukianza kufika 40 years and above, like where some of us are, unaangalia nyuma unashangaa, what was I doing? Na ulikuwa na pesa, unaangalia nyuma unaona kweli I was making money, but where is it? Yote ni pizza, yote ni trips za Naivasha, yote ni tickets za ndege kuenda sijui wapi. You have nothing to show. Wale ulikuwa unaona wakiwa wajinga ati yote wana invest, ikifika Friday wanaenda nyumbani tu very early in the morning, very early in the evening, because they have no money. Saa hii ndio wana plots wanauza millions. Now they can afford to sell one, wanakipia Seychelles, wanauza ingine, anapeleka mtoto ng'ambo. Wewe bado una hustle, unang'ang'ana. So these are things that you really need to consider. It's only that I don't have time to discuss a lot, but I think I've made my points. The next thing is you use unpopular labor policies when you realize that the deadline is coming. You see, like now, we are almost supposed to, actually now I should be doing revision. But bado sijamaliza syllabus, but I think ika handout nitakuachia utajisomea, so that on Saturday I'll just do a few questions. Now, when I give you this handout, I will have finished my syllabus, maybe by Saturday. But what is are the students understanding what I'm saying? Have they understood? That's a question you need to ask. When the HOD tells people, don't go home today until the deadlines are met, until you have delivered this and this, and guys are leaving office past midnight, those guys will go home but very dissatisfied. They will go home to cause even, to find that there is even more trouble, because some of us, we have to explain where we are coming from. Those ungodly hours. Now, when all those things are done so that we satisfy the demand or we meet the deadlines, you find that we cause more trouble. We cause more trouble simply trying to meet the deadlines, which are not good. So how do you deal with this? One, you lengthen the measurement period. Kama sasa hii yangu ya kumaliza syllabus, wangeniambia sasa badala ya kumaliza syllabus by July, wanipatie mpaka September. Lakini naona September mitihani itakuwa imeisha. So now that one can't work. But kama ingefanya kazi niende kabisa niwaambie wewe kocha, sijamaliza syllabus, hiyo mtihani mlete November. So ndio nifunze pole pole. That could work, but now in some cases that can't work. The other thing is you incorporate non-financial measures. It is why you say, in as much as we were given the handout, kama ni maswali tulifanya maswali mingi. Like today you can see I've done I think almost 3 questions, the computations. Although I have not taken a lot of time to discuss and to explain a lot of the theory, na mimi nimechukua time to do what? To do the computation. So you balance those things. The other thing is you improve the accounting measures. So improving the accounting measures, there are some things that we are going to bring on board, which are called economic value added. So if you look at where we have economic value added, it is where we bring some changes. And these changes, I think we shall discuss them. They are discussed there, accounting adjustments. Ukiangalia hapo kuna accounting adjustments. These ones are issues to do with interest on debt, marketing, research, depreciation, goodwill, non-cash expenses. Those ones I will better explain as I handle a question next time. There is that question that is number 5. That is the one that we shall handle as we explain all that about economic value added. I would highly recommend that between now and the time we meet, you go through the handout from page 17, where we have financial statements analysis, all the way to the end. All those are theories. There is no computation. To page 25, they are just theories, so that now when we meet on Saturday, I just solve that question, and we call it a syllabus covered, so that you can have 1 or 2 days of looking at 1 or 2 questions for revision. So thank you so much. We call it a day at that point.